Over the course of the next 30 minutes or so, I'm going to be having a look at how we account for private equity funds. We'll start off by looking at a little reminder of the funding process and the relationship between the limited partners and general partners, and how we might then account for the private equity funds. We'll look at the remuneration of managers and how this is accounted for, the carried interest, which the general partner receives, also the valuation of portfolio companies, and how we measure the returns of private equity funds. We'll cover what the general partner needs to communicate to limited partner investors. And then at the end, I will summarize by going over some abbreviated accounts for private equity funds. Then, when we're able to exit from the companies after a period of, say, 5, 6 years or whatever, then we will exit through an IPO, possibly, or maybe a trade sale, or even a sale to another private equity firm. And the cash will be received from this transaction and put back into the fund and then distributed back to the limited partner investors. And this will generate the internal rate of return for the limited partners. The actual accounts of the private equity fund are prepared in accordance with international financial reporting standards, IFRS, or indeed, if it's an American company, under US GAAP. And under IFRS, you are meant to actually consolidate investments uh, when these are controlled through a ownership of more than 50% of the equity. And if you have more than 20% of the equity in a company, then you are meant to record them as if they were associates.